I think the question has now shifted from the investors asking, will the Fed cut rates at the next meeting, to how much will it cut? So the debate about 25 or 50 basis points. So this is a big development for markets. And I think it was fueled by, of course, some weaker macro data, but especially the last US job report that showed hiring decelerate quite drastically by around a half since the beginning of the year to 114,000 in July.
This is Converge, a podcast from Convera. Come with us as we shape the future of finance. Welcome back. It is a Converge market update today. It is August 14th, 2024. I have Boris Kovacevic back for today. Boris, this episode is brought to you by volatility. I would say that global markets, it's been quite a couple of weeks in the past 2 weeks. Last time we talked about how eventful July as a whole has been, and therefore the beginning of the second half of 2024 at large has really been quite notable. And you mentioned that there is no reason to suspect that August will be any different due to the plethora of risk events coming up. But be honest with us, how surprised were you to see this much volatility in August with the meltdown in the yen and equities last week?
Well, I think it's quite fair to say, Alex, that it took everyone by surprise. We could probably spend the whole episode just looking at individual markets that experienced record-breaking moves last week, which of course we won't do because there are other topics we would like to cover as well. But just to give you a flavor of just how unique the unwinding of positions had been, we can look at these two big examples. First, the Japanese equity story, and then implied volatility overall. So in July, I think at the peak of global optimism, Japan's stock benchmark finally reached its record high from the 1990s after rising by around 27% year to date. And then last Monday, all of a sudden, it recorded its second largest daily drop in history as it fell by around 13%. And of course, this equity drawdown led to a spike of the implied equity volatility gauge to its highest intraday level ever recorded. And a lot of these popular carry trades, like the yen-Mexican peso currency pair, for example, were briefly up 7% as well on the day. So it wouldn't be exaggerated at all to say that last Monday has really been historic. But I would say that what makes it even more unique is that almost all of these extreme movements have already been paid back completely, with most volatility indicators back to the levels before the spike. So in some sense, you could say that it's like last week never happened if you purely focus on market pricing and look at the chart from a weekly basis, even though I think it did change quite a bit in investors' minds, which will have implications for markets down the line.
Yeah, I mean, it's really interesting how you can have such a historic spike in FX and bond market volatility and then completely reverse back in a matter of days. I think it really speaks to the uncertainty that's embedded into market pricing right now, because everyone is trying to gauge where inflation is headed and what central banks will do next, it seems. So is this the reason for last week's volatility in your view?
Yeah, I think we have to see this as a two-stage process, I think. So the initial impulse for the drastic rotation from risk assets to these safe havens did come from the US macro side, as it mostly does in 2024. We had quite a dovish FOMC meeting in which Jerome Powell opened up the possibility of a rate cut in September, which has since then become the broad-based consensus on Wall Street. I think the question has now shifted from the investors asking, will the Fed cut rates at the next meeting, to how much will it cut? So the debate about 25 or 50 basis points. So this is a big development for markets. And I think it was fueled by, of course, some weaker macro data, but especially the last US job report that showed hiring decelerate quite drastically by around a half since the beginning of the year to 114,000 in July. And this initial macro catalyst, this weaker US job growth, then triggered investors to close their overstretched positions in trades that had been really popular all throughout 2024. So we're speaking about shorting the low-yielding yen, buying high-yielding currencies, emerging markets like Brazil and Mexico, betting on Japanese equities, betting on US tech equities, but of course also shorting volatility as investors expected the Fed to cut interest rates soon. And these trades grew so large on a global scale that unwinding them became a negative feedback loop in and of itself. So while the markets have recovered, as I said, mostly from the Monday unwinding shock, so to speak, bond yields, the US dollar, but also Japanese and US equities are still lower than they were going into the second half of 2024 because of the macro factors that led to the unwinding in the first place, namely the weakening US growth outlook, but of course also the rising expectations of Fed cuts. So Japanese equities, I think, are a good example to highlight this because the benchmark, the Japanese equity benchmark, is up around 19% since the Monday bottom, but it is still down around 15% from its July peak.
Interesting. So, as a broad summary, would it be fair then to say that the shock on Monday was purely about investors unwinding positions, but that the negative risk sentiment in July and August is about actually weaker macro driving up these rate cutting bets?
Yeah, I think that summarizes it quite perfectly. And if we actually go a step further, it also gives us a good formula to gauge how durable these trends are and how long they could last. Because gauging the size of this global yen carry trade is almost impossible, right? Because you would have to differentiate, first of all, between speculators like hedge funds on one side, and then institutional investors in Japan, like pension funds, for example, betting against the yen. And we have a pretty good handle on the former because we have options and futures through, for example, data from the CFTC, which shows most of the yen shorts having already been unwound, which is a good thing. But the bigger portion of the trade would come, as I said, from Japanese investors. And it's really hard to say how much unwinding there still is to happen, which I think why we in our research have focused more on the macro part of the equation, because it's less complicated, it's much easier to gauge. And there it is still up to US macro and monetary policy to turn the tide. If we see continued weakness and this increasing recession risk, it is really hard to see yields or the dollar continue to rise as the Fed is expected to cut rates. And it is therefore, I think, not surprising that investors are still on the edge. The cost of protecting against further downside in equities is really high. And the Fed has been featured on US earnings calls like never before in the second quarter of this year. And US recession is still the biggest tail risk for investors, according to the fund manager survey published by the Bank of America.
Got it. So, staying on the topic of recession risks in the Fed, markets are currently pricing in 7 rate cuts over the next 7 meetings. It's a lot, which would really only be plausible if the U.S. economy continued to cool significantly. So, it's a hard landing. The base case now, when you look at the market pricing, is that really sort of where it's headed?
Yeah, so the current pacing of these expected rate cuts is, as you said, indeed only seen during US recessions. So you could argue that the Fed funds futures are pricing in a hard landing. And you could also make the case that this extreme pricing would actually be in line with most leading indicators. And the Fed's own model putting the recession probability over the next 12 months to around 60 to 65%. So you wouldn't be wrong with that matter. I think, however, most other asset classes, if you look at equities, if you look at credit and fixed income markets, if you look at volatility indicators, they put the probability closer to 30%. So you have a huge divergence between what is priced in for the Fed itself and what is priced into the other asset classes. And that is the crux of the matter, because the expectation for significant policy easing, it is compatible with some leading indicators, as I said, but it is not aligned with the pricing in most other asset classes. And this is why, again, gauging how likely this hard landing is, you would actually have to look at markets from a global perspective instead of just looking at the Fed funds futures.
Okay, so a big gap in pricing still, which I guess is what makes the market so interesting right now. This uncertainty that's surrounding these key issues on the policy front. We also just got the latest US inflation numbers from July. Let's talk about those. Just before recording this podcast, how did you perceive the print in the context of gauging the Fed and where the economy is headed?
Yeah, I think both the PPI report and the CPI reports from yesterday and today came in a bit on the softer side. We had headline inflation falling from 3% to around 2.9% in July, core inflation cooling from 3.3% to 3.2%. So this has, of course, been welcome news for markets and investors, but I don't see it as meaningful enough to change the consensus on Wall Street, which is still that the Fed will cut rates in September. The CPI subcomponents, I think that is interesting as well to look at for housing and for car insurance. And these components are important for the PC report coming out later this month, which is the preferred inflation gauge for the Fed. It is expected to rise a bit in July once again, but nothing that would really move the needle in terms of what is priced into Fed funds futures. So while inflation remains important, it is market moving. I think labor market data has kind of overtaken inflation data as the main risk event for the second half of the year, in comparison to inflation really dominating the first 6 months of 2024, meaning that the next job report will most likely decide if we get a 25 or a 50 basis point cut at the next FOMC meeting in September.
You mentioned the PCE report there. Let's stay at the topic of upcoming events. What do you think people should watch out for in the weeks ahead, both in terms of the risk events, but also maybe specific markets that are at a turning point? What should we think about?
Yeah, great question, Alex. As you know, in our last episode, I think we talked about the month of August really being decided by just 10 trading days due to this concentration of risk events that started this Monday. And the slowing inflation data from both the US and the UK today set us up quite nicely for the upcoming events and have, as I said, been really well received by investors. But the attention now shifts more to the US retail sales report tomorrow, but especially the political events next week, because we have the Democratic Convention on Monday, we have the Jackson Hole Symposium on Thursday, and especially the latter will give policymakers, not only US policymakers, but central bankers around the world that are gathering in Jackson Hole, they'll give them another chance, I would say, to fine-tune their communication regarding these expected rate cuts. And then in the closing week of August, we already mentioned it, the PCE report will probably close out the month. And in terms of individual events, now shifting from these risk events to markets, I think dollar yen will probably remain the most watched currency pair in the world. It is still down about, I would say, 9% since peaking in July, despite the 4% bounce from last Monday's lows. Additionally, I think euro dollar is also watched closely because it's back above the 110 mark for the first time since January. And then on the fixed income side, we have the US 2-year Treasury yield again back below the 4% mark. So I think I'm keen to see how these three assets will develop until our next episode in 2 weeks.
All right. Well, once again, it has been a surprise after surprise, and we're looking forward to what's coming in the fall season just ahead of us around the corner. Boris, thanks again for being with us today. We'll chat in a couple weeks.
Always a pleasure. Thank you, Alex.